I have a little bit of experience on this right now. You guys know I'm working on a deal in Indiana, and I've pulled all the data on it, and there's not a lot of data. So the question is there opportunity here? Or is there not a lot of data for a reason, right? Because there is no opportunity. Because markets are really efficient. Markets find the money, right? There's nothing they do better than that. But one thing that I did, and disclaimer, kind of like what Chase said, we're getting off the back of the envelope to a certain degree. But if something is close on the back of the envelope, you're like, I got to dig deeper, then it passed the initial smell test.
Yeah.
How many deals have we looked at on the back of the envelope? We've gone, we don't need to spend one more breath on this deal. It's done.
Welcome to the Build to Rent Podcast, the first ever real estate show dedicated exclusively to helping investors go from raw dirt to a cash flowing rental property. Whether you're looking to do a massive syndication or a one-off rental property, the Build to Rent Podcast will help you get there. Our hosts, Steve Olson, Chase Levitt, and Sherida Zanger, bring together more than 4,000 properties of experience as they break down how to find and finance projects, make the most of market and tax strategies, and maximize the returns of a build-to-rent portfolio. This is the Build to Rent Podcast. And now, today's episode.
Welcome to the Build to Rent Podcast. I'm Steve Olson with Chase Levitt and Sherida Zanger here, getting an episode out of the can for you that I think you're going to find helpful. We've got some good ideas to bring to bear here about analyzing your build for rent deal. And the whole purpose of this, guys, is to more of kind of a back of the envelope analysis of the deal, right? We don't pretend that you're going to go to the bank with this stuff, that you're going to close with this stuff, but it's how do I vet something out? And really you have to, if you're doing a lot of deals, you really have to systemize that. You know, I've got a guy right now that I'll tell you guys about that. He's a financial nerd, right? And so once I get past the back of the envelope, right, then it's time to spend some money with the nerd. Okay, it's all right, dig much deeper into this, build out all the complicated models and your returns and sources and uses and all this kind of stuff. But for our purposes here, whether it's you're going to build a little house, whether you're going to build 50 townhomes, this is a back of the envelope analyzing a deal really quickly, kind of a formula. Chase, from its most basic point, where do you start?
The rents, figuring out what the rents are in that market. It could be a single family home, townhome, apartment building, whatever it is, just take it one unit at a time. And really just analyze the rents by calling property managers in the area, different assets that are currently being managed in the location that you're looking. So look at the rents, take a real close look, understanding what product type, if it's to be built and it's not there yet, understand what you want to build there, and then look at similar comps within that location.
Similar comps being the key. Sherida, what do you do? How do you analyze rents?
Well, obviously, if it's something that is existing, you're going to call property management and get those rents. So you can back into it that way, obviously. That's a quick way to analyze an existing property, but same thing as Chase. I'm going to look into the area, see what things are renting for, visit some property managers. See if I know someone, I can call around and ask them, hey, what are you currently getting for rent? I know my kids bought some townhomes in American Fork, Utah, and I had asked somebody, hey, what are current rents? It was actually one of our associates, just because she has leased quite a few units in there, just to kind of see. So you can ask around. People usually are pretty friendly, and we'll give you advice if you ask.
And then let's take it a step further. Besides the rents, where else are you getting income? Garages, washer and dryer, pet fees. We have a tech package. There's a lot of different ways you can get additional income. So once you understand the rents, how else are you going to get income to really understand your monthly gross income? And then once you know your monthly gross income, just times that by 12, and that's your annual.
Yeah, that really is the jumping off point. And when we're talking about build for rent, because the value, what you're willing to pay, what you could potentially sell the property for, all jumps off of that. What is the income? That's what somebody is buying, right? They want that income stream with the property. So that's what the value is derived from. So I think we kind of get to the point where what's a quick valuation? What's a back of the envelope for one investor versus another, right? On a high level, you're just looking online. You might look at CoStar. I mean, we have a CoStar subscription, which I actually kind of like. It's a ripoff. Okay.
Super expensive.
Yeah, they might cancel us because they are kind of like the soup Nazi from Seinfeld. Like you complain, no CoStar for you. Yeah. Preston, we're going to need to get the soup Nazi dubbed into the episode. We have it in the budget to pay Seinfeld royalty rights, don't we? On the show? We don't. Okay, we might use it anyway. So CoStar has a lot of good information that you can see the typical rents for 1, 2, and 3 bedroom units in your area. You can pull comps at half mile, 2 mile, 5 mile, as big of a radius as you want. You can sort it by their star rating, 1, 2, 3, 4, 5 stars or so, right? So you can go pretty deep in a back of the envelope and get some really good ideas. But once again, take it with a grain of salt, because like what Chase was saying, I haven't actually always found CoStar to be very good at telling you the rest of the story, right? Is there a $50 parking fee? Some of the listings say that. Mm-hmm. Some of them don't. CoStar is only as accurate as the diligence of the analyst, right? I know the three of us get calls. This is Bob from CoStar. Hey, you got this property that just went to the city. Tell me about it. Or, hey, you sold this one. And we have to give the information. So it can be a case of garbage in, garbage out, right? If somebody didn't give the CoStar analyst very good information, you got to take that into consideration. So it's a high level, but you're definitely going to need to drill down onto it later.
But if somebody doesn't have the funds, right, to pay for a CoStar account, they can use resources like Rentler.com, Apartments.com. Some of those, I know locally different places have their own platforms that they use as rentals. So that's a good place to start too. Usually those are a little more detailed because they're looking for the tenant, right? So they're looking at the tenant saying, hey, come rent from me. So they'll give a little bit more information than maybe some may have on CoStar.
And that's a good thought, because this whole episode is doing it within 5 minutes or less. It's the quick and dirty. And so the way that you do that is, the CoStar or the Rentler. When you start to call different places, that's going to be more time consuming. That's just diving in a little bit deeper.
We're probably off the back of the envelope and onto the spreadsheet by then, right?
Yeah. So the quick and dirty, Rentler, Zillow, any place where you can just get an understanding what the rents are going to be. And then once you understand what the rents are going to be, we can talk expenses. And we're not going to dive deep on those quite yet, because this is the quick and dirty, right? And so you just take an expense ratio. For our pro formas, we're anywhere between about 33%.
Yeah, I've done a few 35s, but somewhere for what we do together. And we're not claiming that that's the universal expense ratio either.
Yeah.
Right? Mm-hmm. But you need to come up with one that you feel like captures everything, because you add everything up and you say, okay, 35% of my monthly income is going to be pushed over to expenses. We're not so concerned about the makeup of those expenses yet, right? Well, what percentage of that is taxes? What percentage is maintenance, right? We just need to know what's our net operating income.
We need a placeholder. So that's pretty conservative placeholder that we found.
Now, before we got into that for a second, what do you guys think about Rentometer?
I actually like Rentometer. I paid for the pro subscription, I think, to Rentometer. I think there's some good things. I know I've used it when we've analyzed a few properties or projects, I guess I should say. So I think they have some good information. Sometimes not as detailed like as a CoStar would be, but I think they all bring, I guess, have their own benefit to it. But I found it useful.
Well, CoStar would give you what big property managers and apartment complexes have listed or have reported as closed. Rentometer, if you're in a market that has a lot, like a hodgepodge of inventory, right, where people are listing it online through some of these places, Rentler and whatever, it's a good way for you to see, am I reasonable, right? I love the little die. It's like a speedometer, right? When you say, I have a 3-bedroom unit, 2.5 baths, here's the street address, and I want my rent at $1,800. Rentometer will tell you, the little speedometer says very affordable, very unaffordable, right? And they're analyzing everything that's listed and available. So that's a good, valuable perspective, because you go, if I'm a tenant and I Google a property to rent, what am I going to see? And then myself as the builder developer, what is my target going to see in relation to what I'm advertising?
Yeah. Because you have to be competitive, right? You can't be the lowest rent, but you can't also be the highest rent.
What do you think? And we didn't talk about this before. I don't think the listeners would be surprised. We don't talk about a lot before the show. All right. But what if you don't see a lot of comps at all? I mean, what if there isn't any data? What alarm bells or what green lights go off in your heads when you see that?
Well, obviously, I would think if there's not a lot of rentals, then maybe it's an area that does need rentals. But again, you're going to have to dive a little bit deeper to see, is there a need there? It could mean that there is no need too. Mm-hmm. So, right, going to the red side saying, oh, maybe this isn't like alarm bells. This isn't the right area. So, I mean, that's going to be talking to the city. That's going to be a little bit more due diligence than a 5-minute analysis, right?
But for the 5-minute, take an estimate.
Yeah.
Take an estimate of what you think it's going to be, or expand to another city that's maybe 1 to 2, if it's 5 miles, whatever it is, your best next comp. And then take that one. And then when you dive deeper beyond the 5 minutes, that's when you start to call the city and say, okay, what's the need here? And you really dive into it deeper.
Well, that kind of reminds me of our Nampa project, right? We didn't have anything, there were no comps, like literally nothing there. And we thought, okay, we've got to be a little bit lower than Meridian. Where do we want to be? And we kind of shot from the hip, and luckily we shot low. And so rents are quite a bit higher, which is amazing for our investors. But that was one of those markets that, again, we were like, what do? We don't want to be overly aggressive.
Mm-hmm. But that's good. You bring up a really good point. We estimated, but we were conservative. We felt we were conservative. And at that time, I think we probably were or spot on. And then over a period of time, we found out that they're actually about $100, $150 per unit higher, right?
Yeah.
Right now.
Which that brings up another point. So I was running a pro forma. The cap rate was a little bit on the low side. And the seller, who is my client, said to me, hey, what if we projected rents? And then this also came up in a conversation I had with Steve Olson, where he said, hey, right now where these rents are for this existing property are a little bit on the low side. Property management thinks when they renew these, they're going to be a little higher. Again, that's a gamble and a risk that you're hoping that the market is still pushing up, which it should in the climate we're in right now. But again, it's kind of an unknown. So some people may purchase something that's at a lower cap rate knowing, hey, I can hold for 6 months till these leases renew and actually get a couple $100 more in rent a month per door.
Well, it's true on that deal that you're talking about. They have existing leases getting signed for like 150, maybe 200 more than where this particular unit is at. So it would take the market really suffering, because we're not hoping, we know where they're coming in at, right? And that's tricky based on time of year. There's some variables that can get you there.
It's a value add.
Yeah.
It's an easy value add if you understand and do your research, like, oh, wow, they're low.
Well, and you figure out when the leases are up, right? Hey, when are these leases going to be up? Is it going to be up in December again, and they're going to not get me as much as they could maybe in a summer month, depending on what market it is? Yeah.
Do a 6-month renewal and then take that thing all the way up to full market. I have a little bit of experience on this right now. You guys know I'm working on a deal in Indiana, and I've pulled all the data on it, and there's not a lot of data. So the question is there opportunity here? Or is there not a lot of data for a reason, right? Because there is no opportunity. Because markets are really efficient. Markets find the money, right? There's nothing they do better than that. But one thing that I did, and disclaimer, kind of like what Chase said, we're getting off the back of the envelope to a certain degree. But if something is close on the back of the envelope, you're like, I got to dig deeper, then it passed the initial smell test.
Yeah.
How many deals have we looked at on the back of the envelope, we've gone, we don't need to spend one more breath on this deal. It's done. But something that I found valuable, and I think I've said this on the show before, if I see a low vacancy rate, this market I'm looking at is a 2% vacancy rate right now. That tells me, okay, there's got to be a need for more inventory. I looked at comps. The newest apartment complex was built in the early 90s. Right? So I'm going, okay, they got it. The unemployment rate is really low. Vacancy is really low. Housing stock really old. Right? I'm looking at all these things. So what I wanted to be careful about is, are there fish in the pond? Right? So I used a website called Neighborhood Scout. and you can get this information from a bunch of other places, but I use Neighborhood Scout to find the median income for the area. And, when we had Lane Aldrich on a couple of weeks ago, he would tell you lenders, to gauge whether somebody can afford a mortgage or a rent payment, they like it to be 33 to 35% of the monthly gross income. So I'm looking, what is the median salary for the area? And are the rents that I think I can get that are a little fuzzy because I don't have a lot of data, are they more than that? Are they more than 30 to 35%? And if they are, there's probably not a lot of fish in that pond, right? There's probably a reason why some other developer or builder hasn't come in there and put up a bunch of units. But if the average salary can afford what you want, to me, that might be a very bright green light where you say the market is wanting more inventory. What do you think about that?
I agree. And I also think even maybe looking, if there's not a lot of data, looking at what single family homes are selling for.
Yes.
What are people purchasing? And then what would their mortgage roughly be on that? Now kind of back into it that way and say, okay, so they're willing to pay this to own or occupy something, right? To live in this property and own this. And there's a lot of people that are tenants that can't quite qualify, but they do make some good income. So maybe just saying, okay, maybe we need to be a little bit below what that is or close to. But I mean, that's another avenue to go down.
The MLS is good too.
Yeah.
Now here, our MLS in Utah for leases is garbage. Okay, it's completely useless. But yesterday I was doing a little secret shopping on a property manager we use in Texas. Okay, and I had John, one of our key contacts, pull the MLS data. This is in Houston, right? They have a great MLS for leasing detail. I can see average days on market to rent this unit in this project is 24, right? Here's the price. You can see it's all right there. So you might have a very robust MLS in the market that you're looking at as well that could tell you where these rents are going to come in.
Yeah.
Just talk to people as well.
Yeah.
Talk to the city, talk to, people in the area and see, they know their market, they know their city and what demand or need there is. And so just talk to them and they can probably spill a lot of beans to you.
Yeah. Yeah.
Okay, but let's go back. So really what we have now is we have our rents, we have our expenses, right? So we're going to try to do this in 5 minutes or less.
Yes.
So where do we go next, Chase?
Finding your NOI. If you can find your net operating income, this is the formula. Net operating income. And then if you want to divide that by what you think the value is, then that's going to give you a cap rate. The cap rate of what it's performing at. If you find your NOI and then divide that by the cap rate of where you want to be, let's say it's 5.5 or 6%, that's going to give you the value of the property or what you should pay for it.
Are you seeing a 6% cap rate right now?
No, and then that's the other trick too, is you need to understand what the going cap rate is for that market. And there's ways to look into that as well. We've seen and know that it's about a 4.5 cap right now. That's what things are trading or selling for.
Depending on the market, right? But most of where we operate is I mean, that's not a Toledo, Ohio cap rate, right? That's a Salt Lake, Phoenix metro cap rate.
Even Boise.
Boise might even be less.
Yeah.
Crazy.
They're insane right now.
Yeah.
So I skipped ahead a little bit. So I want to back up. So I said NOI, net operating income. We didn't talk about that. The thing that we talked about before that was the gross annual rents, the yearly gross rents, right? And so let's just take an example. Let's make it really easy. So let's say we're looking at either a single family home or a townhome, 1 unit, 1 property. Let's say it rents out for $1,000 per month. Well, we know per month it's $1,000, right? What's the yearly? You just times it by 12. Okay, so where are you at?
12 grand.
12 grand. We need to back out the expenses. And so what is our expense ratio going to be? So if it's newer property, less maintenance, the expenses are probably going to be lower. This is something that you'll dive into deeper later. But for the sake of time, we'll just say it's 35%.
Now you're going to make me do math in a weird way.
Well, let's do it easier.
It feels like that, doesn't it?
Let's go back to the 1 unit. $1,000 per month times 65% is $650.
$650. Times 12. I can't
Times
do that
12
math
now.
quick.
It's
Olson,
okay.
come on.
We don't have to. But this is just a simple example. So $650 is what someone's going to be netting on that 1 unit per month. Times it by 12,
7,800.
7,800, right? And that's what's called
He did use a calculator, everyone.
It's on the video. I mean, yeah.
that's your yearly, or that's the net operating income. So NOI is the secret. Once you can estimate quick and dirty NOI, then there's a couple of different ways you can figure out cap rate by just taking your NOI and dividing by the purchase price or what you want to pay for it, and that's what your cap is going to be. Or if you want to figure out what you should pay for it, you take your NOI, divide it by the cap rate. If you want a 6 cap, hey, I know what the net is. This is my quick and dirty. What did you say, $7,000?
7,800.
7,800.
Yeah.
And I want to buy this townhome or this single family home at a 6 cap. And then divide it by 6%. And that'll give you a price.
And we'll get into this on the next episode, but just because you want to buy it at a 6 cap doesn't mean that's what the market will give you.
Doesn't mean you're going to get it.
That's
So
right.
I know a lot of our to be built are between a 5.5 and a 6 cap, right? So that's to be built construction. You're going to have to wait a lot longer for that. So let's just clarify that those deals are out there, but there's things that you're going to have to wait for, or in different markets, not the markets that we're currently in right now.
Yeah. Well, that's the point. If you want to do a cap rate better than what the market will give you, well, what are you going to give the market?
Yeah.
What risk are you going to take?
Yeah.
Yeah.
Okay, so did I miss anything? Was that confusing?
No.
Pretty simple, right?
I think it's great.
Yeah.
Yeah. And then once you understand that and say, okay, well, this is going to be a 6 cap, or yeah, this is the value of my property, whatever you're looking to do there, then just dive a little bit deeper and make sure you have all your facts straight. The rents, the expenses, et cetera, et cetera.
And kind of like Steve and I were talking about, hey, if you know that those rents are going to go up a little bit, you can have, hey, this is what my cap rate is right now, and this is what I projected at, and maybe that makes sense to you.
Yep. Excellent.
That's it.
Okay.
That's all she wrote. We'll catch you next episode on the Build to Rent podcast. Thanks for listening, everybody. And remember to subscribe on iTunes, Spotify, and the Google store. Isn't it Google? Yeah, whatever that is. Whatever Android people do. So thanks, everybody. Catch you next time.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube. The information presented in this podcast is general in nature. Nothing in this presentation should be construed as financial advice or recommendations for any particular situation. The hosts are only licensed to provide advice and services in the states where they are specifically licensed, and listeners should seek the advice from an appropriately licensed professional in the area where they invest. The examples presented in this presentation are for illustration only, and no guarantee that similar results can be achieved, since the facts, circumstances, and participants are all different.